Hello, everyone. I'm Shawn Garcia, Marketing Manager here at Mazars in the U.S., and I'd like to thank you for attending our webinar. Today, we continue with the 5th session of our REITs webinar series, Foreign Investments, which will be led by Craig Stern, Donald Zief, and Timothy Evans. Before we begin, I'd like to review a few housekeeping items. First, we encourage you to ask questions. To do so, please send them to us using the Q&A box on the lower left-hand side of your screen. We will try to answer all of your questions during the webinar, but if a fuller answer is needed or if we run out of time, your question will be answered after the webinar via email. Second, to earn the available 1 CPE credit during today's webinar, you must listen to at least 50 minutes of the presentation and answer at least 3 polling questions. The polling questions are a series of questions meant to confirm that you are actively attending this webinar. Please note that you must be logged in individually to receive credit for today's webinar. If you are attending as a group, only the individual who is logged in will receive credit. If you've completed the requirements, your certificate will be available for download at the end of the webinar. Instructions on how to download your certificate will be displayed on the screen at the end of the presentation, so please stay on the line. Lastly, you can download a copy of today's presentation from the green Resources button at the bottom of your screen. Here, you will also find our webinar Frequently Asked Questions, a document which offers some basic troubleshooting information and other useful tips. Again, this can be found under the green Resources button at the bottom of your screen. Now, thank you once again for joining, and I'll hand it over to Howard Landsberg, a partner here at Mazars. Howard?
Thank you, Shawn. Good day to you all. I'm Howard Landsberg, and I lead the real estate tax practice at Mazars in the United States. I'd like to welcome you all to the 5th installment of the Mazars REIT webinar series, Foreign Investments. Mazars is a leading international audit, tax, and advisory firm. We operate as a united partnership, as one integrated team who leverages our expertise, scale, and cultural understanding to deliver exceptional and tailored services around the globe. Mazars has more than 26,000 professionals operating in over 90 countries and territories. Throughout the webinar series, you will learn more about the Mazars REIT practice, our experts, and technical REIT subjects. Today's webinar, Foreign Investments, will be led by Craig Stern, Don Zief, and Tim Evans. Craig has more than 30 years of experience in the real estate and investment industries with a focus on transaction services. He has worked on over 100 mergers, acquisitions, dispositions, joint ventures, inbound investments, and spin-offs, with deal sizes ranging from $1 million to $6 billion. Don also has more than 30 years of experience in the real estate industry, focusing on REITs. He's the co-author of the Real Estate Investment Trust Handbook, published by Thomson Reuters. Tim has more than 10 years of experience in structuring inbound and outbound investments in the real estate industry. Thank you, and here's Tim to start us off.
Thanks, Howard. Hello, everyone. So today for our discussion of foreign investment in U.S. real property, I'm going to begin looking at an overview of the U.S. taxing regimes as they're applicable to foreign persons. So specifically, that's going to be the fixed, determinable, annual, or periodic regime, which we refer to as FDAP, and the effectively connected income regime, which we refer to as ECI. Following that, Don will discuss the Foreign Investment in Real Property Act and how that impacts investment in U.S. real property. And finally, Craig will walk through some potential structures for foreign investment in U.S. real estate. So first topic, U.S. taxation of foreign persons. Again, that's the FDAP and ECI regimes. So first, just to put things in context, international tax rules generally are designed to resolve, well, at least mitigate one fundamental issue, which is double taxation. So double taxation can potentially arise when you've got both a residence country and a source country imposing tax on the same item of income. So when it comes to foreign investment in the U.S., the residence country of the foreign investor, they may impose tax on the investor based on its worldwide income. And then you've got the U.S. as the source country, which may be applying tax on income that's been earned in the U.S. or that is derived from U.S. sources. And so sort of layered over all of these rules are double tax treaties, which can play an important role in this process. So foreign investment in the U.S., we refer to this as U.S. inbound taxation, which is the taxation of foreign investors with respect to their U.S. investments. And here we're focusing on source country taxation, so the U.S. taxing based on income derived from U.S. sources. This is a little bit academic, but effectively what we're talking about here is the sovereignty principle at work, which is basically giving jurisdictions the right to levy tax on activity that occurs within their jurisdiction. And unsurprisingly, the U.S. exercises this right in full. So some important terminology to keep in mind as we go through this presentation. We've got U.S. person, which is going to be defined as a citizen or resident of the U.S. Resident of the U.S. might be either through, obtaining a green card or also meeting the substantial presence test in the U.S. Also, any entities that are organized in the U.S. will be considered U.S. persons. And then non-resident is defined with reference to U.S. person and essentially is including anybody that is not considered a U.S. person. We've got the definition of U.S. trade or business. So as we're going to discuss, the U.S. taxes non-residents on income that is connected with a U.S. trade or business, right? That's ECI. So the definition of what constitutes a U.S. trade or business is going to be important. So this is really a facts and circumstances analysis, and the idea is to look at whether activity is regular, continuous, or considerable. No bright line rule here. You just have to consider all of the facts. Importantly, activity can be attributed to foreign investors through pass-through structures. So if a foreign person invests in a U.S. partnership and that partnership is engaged in a U.S. trade or business, then that trade or business can be imputed to the foreign investor. And that's going to be an important consideration for some of the structuring that Craig is going to discuss. Lastly, the source of income is extremely important. So the U.S. is going to tax foreign persons mostly only on their U.S. sourced income. And we've got various sourcing rules that apply depending upon the particular item of income in question. A couple of those common rules are provided here. So dividends are sourced to the residents of the paying company. Interest is sourced to the residents of the payor of the interest, services to the place of performance, and royalties where intellectual property is used. So as I've noted, the U.S. is going to tax foreign persons on their U.S. sourced income, and we break this down into three categories. So the first category is U.S. sourced income that is effectively connected with a U.S. trade or business, referred to as ECI. The second category is portfolio income. That's the FDAP, fixed, determinable, annual, or periodic. It's going to include dividends, interest, items like that. And then the third category is deemed U.S. source income. So this is income that might ordinarily be considered foreign source, but special rules are going to apply to basically deem that income to be ECI. And one classic example of this is capital gain derived from the disposition of U.S. real property interests. So, our capital gain rule generally is that capital gains are sourced to the seller of the asset generating the capital gain. That's not the case for U.S. real property interests, and that topic will be explored further by Don. So what is ECI? Again, what we're talking about here is income that is effectively connected with a U.S. trade or business. And it's income that's going to be subject to net basis taxation. So in other words, foreign persons, they're going to be taxed on their ECI at standard, individual, and corporate rates on the income minus allocable and apportionable expenses. There are certain circumstances, particularly with regard to partnerships, where ECI is subject to withholding. And when that occurs, the income, the ECI, is going to be subject to withholding at the highest applicable rate. So currently that would be 21% for corporations, 37% for individuals. We've got portfolio income. This is a broader category of income, really, than ECI. So whereas ECI is sort of operating income, trade or business income, FDAP is really going to be almost everything that is not trade or business income and that is not capital gain. And unlike ECI, FDAP is subject to gross basis taxation, all satisfied through withholding. FDAP is a withholding regime. So withholding tax is going to be imposed on the full amount of the payment in the case of FDAP. As a general rule, that's going to be subject to withholding at 30%, although there are some statutory provisions that reduce that, as well as tax treaties, which can potentially reduce that amount of withholding. So here's some treaty rates that apply to ordinary dividends by REITs. These are general treaty rates. So you may have specific facts that lead to a different result than is here. The treaties provide for a couple of alternative results. But just to give an example here, let's just take a Canadian individual. The general rule under the treaty might be 15%, but if that shareholder owns 10% or more of the REIT stock, then that withholding rate would increase to 30%. So these are the standard rates. Various factors, such as ownership thresholds, but also there are some rules that depend upon sort of a look-through basis to the REIT, the diversification of the REIT's portfolio. Those are going to come into play to determine the ultimate treaty rates in play. I've included Germany here, and that's sort of illustrative of European treaties in general. Most of them treat REITs in a similar manner, so that'll give you some idea of that. So on these next two slides, I'm going to make some comments regarding tax compliance and reporting that can be applicable to foreign investors in the U.S. So generally, and this ends up being an important structuring consideration, but foreign persons that have ECI are generally going to be required to file U.S. tax returns. So for foreign corporations, that's going to mean filing the Form 1120-F. This would be the mechanism to report the ECI and also to claim the deductions that are allocable to ECI. It's used for a couple of other purposes as well. So you use it to make treaty claims. Just to give an example, if you had a foreign corporation that is generating ECI, but it's excluding the ECI on the grounds that under a relevant tax treaty they do not have a permanent establishment in the U.S., then they would file Form 1120-F with the 8833 treaty-based disclosure, taking that position that there is no permanent establishment, and therefore the ECI is not subject to tax in the U.S. A couple of other uses to point out. In certain instances, a foreign corporation that does not meet the threshold for a U.S. trade or business may still file an 1120-F, and we refer to this as a protective return. And the reason that we do this is an 1120-F generally has to be timely in order for deductions to be allowed against the ECI. So if a taxpayer were to take a position that they didn't have a U.S. trade or business and therefore they weren't filing the 1120-F, If the service later came in and determined that the activity really did constitute a U.S. trade or business, then the taxpayer might find themselves in a position where they can't claim the deductions against the ECI. So by filing a protective return with zeros on it indicating they're not engaged in a U.S. trade or business, that eventuality can be avoided, and you'd be able to claim the deductions on an amended return. Lastly, the 1120F can be used to make a refund claim if the taxpayer is subject to over-withholding. Given we now have a flat corporate rate, we really only see this over-withholding in the context of FDAP payments, which might be subject to tax, for example, at 30%. But if you should have had a preferential rate on that FDAP, then a foreign corporation would use the 1120F to make a refund claim. So for FDAP, unlike ECI, generating FDAP does generally not require or not trigger a U.S. tax return filing obligation. So FDAP payments will be reported to a foreign person on Form 1042-S. And if you're familiar, these are essentially 1099 equivalents, but for U.S. sourced income paid to foreign persons. So the 1042-S would show the amount of withholding that the recipient was subject to, and then that's subject to matching, right? So a copy is sent to the recipient and a copy is sent to the service. And then if there's, I guess, under withholding or over withholding, if there's under withholding, you would be required to file a U.S. tax return to pay over the difference or settle the difference. If there's over withholding, you would file a U.S. tax return to claim back the amounts that were overheld. And so these forms are going to take into account any treaty claims made by the foreign person. So the foreign person is going to provide the withholding agent with one of the W-8 forms, which we refer to as tax documentation. So there's various types. You've got the W-8 BEN for individuals, IMY for pass-throughs, BENE for corporations. And on those forms, you'll make your treaty claims, which the withholding agent uses to determine the relevant or the appropriate withholding rate to impose on the payment. So, providing accurate and valid W-8 forms in a timely fashion is very important to getting accurate withholding. And as long as you've got accurate withholding at source, then it really limits the amount of compliance that you would need to do down the road. So with that, we are going to have a polling question. So back to you, Sean.
Thank you, Tim. So the first polling question of the webinar is up on your screen, and it reads, rents from real estate is generally treated as ECI. True or false? Please make your selection now and be sure to click the submit button to get credit for your answer. We're going to give it just a couple more seconds. Please be sure to click submit to your credit. Okay, let's take a look at the results. So 80% of the audience said true.
So that's a little bit of a tricky one. I guess as the general rule, rents should really be considered FDAP. However, in practice, there are elections to treat income from real estate as income that's effectively connected with a trade or business. So while the general rule would be that rents are FDAP, in practice, rents are very frequently seen as ECI. And with that, I'll turn it over to Don to discuss FIRPTA.
Thank you, Tim. There we go. Thank you. So I'm going to discuss FIRPTA stands for Foreign Investment and Real Property Tax Act of 1980. And if you remember, Tim was talking about three types of taxation the United States imposes. One is ECI on business operations. One is FDAP on portfolio income. And then there's this third category called deemed ECI. In other words, something that's not normally ECI, but it's deemed to be by the code. And that's what FIRPTA taxes. The law generally up till the 1980 is that capital gains of non-residents and foreign corporations derived from United States sources was not taxed. In the late 70s, there was a fear of Congress that there was too much U.S. real property ending up in the hands of non-U.S. taxpayers, and they were not taxed on the sale. So this was a way to put foreign taxpayers owning U.S. real property on an equal footing with U.S. taxpayers. So it's important to remember, FIRPTA applies only to dispositions of U.S. real property interest by non-resident alien individuals and foreign corporations. It does not apply to FDAP that Tim was talking about in his presentation. So what's a U.S. real property interest? So it's an interest in real property, as you might expect, or a non-creditor interest in the United States Real Property Holding Corporation, a U.S. RPHC, at any time during a 5-year period ending on the date of disposition of the shares in that company. In turn, a U.S. RHPC is a corporation where the fair market value of the United States RPIs equals or exceeds 50% of the fair market value of the United States real property interest, plus its interest in real property located outside the United States, plus any other of its assets which are used or held for use in the trade or business. So let me, I use the term interest solely as a creditor. What that means is a loan, for example, that pays only interest is an interest solely as a creditor. That is not the USI RPI. That is not subject to FIRPTA. On the other hand, if a mortgage has what we call an equity kicker, not only is interest due during the term, but there's a percentage of proceeds on sale or gain on sale or a share in appreciation of value, that is the U.S. real property interest. It's not solely as a creditor, and that's subject to FIRPTA. So, is REIT a U.S. RPC? Generally, yes. The U.S. real property generally greatly exceeds 50% of its total assets. On the other hand, a mortgage REIT, if there's typical standard mortgages paying only interest during the term, that is generally not the United States real property interest and is not subject to FIRPTA. And the result, once again, it only applies on dispositions, and the gain on sale is treated as derived from a U.S. trade or business, and it's ECI to non-residents. It's subject to graduated U.S. tax rates, just like any other U.S. taxpayer. The tax rate is reduced by treaty, unlike the table that was in Tim's presentation that showed special rates in other countries. Now, there are a couple of general exceptions to FIRPTA taxation. Oh, sorry about that. One is that the ownership of 5% or less of stock in a publicly traded corporation is not a U.S. RPI. In addition, there's what's called the cleansing rule. What that says is if at the time of sale of the stock in U.S. HRPI, there are no U.S. RPIs held, and during the 5-year period, remember it's a look-back period, during the 5-year look-back period, any such interests were sold in a transaction where all gain was recognized, then that is not the sale of the USH RPI. That is what's called a cleansing transaction. Now, so those are the general rules applicable to FIRPTA, general exceptions. There are special REIT rules and exceptions. So the ownership of the general rule is at 5% or less of the stock in a publicly traded corporation is not a U.S. RPI. With REITs, that's jumped up to 10%. A shareholder of 10% of a REIT and not have a U.S. RPI. There's a rule for the domestically controlled rate REITs and the look-through rule. I'll go into in about a minute. The cleansing rule we just went over is no longer applicable to REITs as of 2016. So in that 5-year look-back period, it doesn't matter if the REIT got rid of all of its properties in a taxable transaction. It's still subject to FIRPTA. And then there's some special shareholders that came in the 2015 PATH Act. We're going to go into in a little while as well. So, first of all, domestically controlled REIT is not a U.S. RPI. It only covers the sale of shares, and that's not subject to FIRPTA. This is the most frequently used exception to FIRPTA. Domestically controlled means that less than 50% of the value of the USH RPC was owned directly or indirectly by foreign persons at all times during the 5-year look-back period, ending on a date of disposition. Less than 50% of the value of the stock in a company. Not limited to publicly traded REITs as the 5% and 10% exceptions were. In addition, it's hard for publicly traded REIT because there's so many shareholders to determine if it's domestically controlled or not. So there's a couple of rules of the road that came in the 2015 PATH Act. If the owner of less than 5% of a publicly traded REIT is traded on the established U.S. securities market, it's deemed to be a U.S. person unless there's actual knowledge to the contrary. Once again, publicly traded REIT on any established securities market in the world, owning a class of stock in a lower tier REIT is deemed to be a foreign person unless that upper tier REIT is domestically controlled. And finally, non-publicly traded REITs, private REITs, owning stock in a lower tier REIT are treated as owned by a U.S. person in proportion to the stock of the parent REIT treated as owned by the U.S. persons. Again, before the 2015 Act, nobody really knew how to apply these rules. There's now what we call rules of the road. Now, importantly enough, the domestically controlled exception does not apply to proceeds received on the liquidation on USH RPC. For many years, tax professionals were of the view that the domestically controlled exception for sale of shares in a REIT also applied to amounts received by shareholders on liquidation of a corporation holding U.S. real property. The reasoning was that amounts were received in exchange for the shares. The shareholder parted with its ownership interest in the corporation and received cash or consideration for shares very similar to an actual sale of shares. The IRS issued notice 2007-55 in 2007 saying that it would challenge such positions in the future. Since that time, there have been many efforts to repeal this notice, both by NAREIT and other real estate groups. Each year, the movement gains further traction, and hopefully in a few years, it's very possible that this rule may be totally repealed. Now, there's a look-through rule applicable to REITs, and this is applicable solely to REITs. This is a second way that shareholders in a REIT can be taxed. So in addition to the FIRPTA tax only on sales of shares in a REIT, a distribution to shareholders by a REIT to foreign persons or another REIT is taxed to the extent it's attributable to gain from the sales or exchanges of U.S. RPIs at the REIT level. Once again, not applicable to persons owning 10% or less of the value of a publicly traded REIT. So once again, just beware. If a REIT is involved, not a non-REIT, but if a REIT is involved, shareholders are taxed, foreign shareholders are taxed on the sale of their shares, if it's not domestically controlled, and are taxed on distributions to them of the gain from the sale of the U.S. RPI by the USH RPC at its level. So I said there were some special shareholders. So in the 2015 PATH Act, two special shareholders came in. One is a qualified shareholder, and this is applicable only to shares in a REIT. There's no concept of a qualified shareholder in any other corporation. So the shares of the REIT are owned by a qualified shareholder are not as a U.S. RPI, and the distributions to a qualified shareholder are not treated as getting recognized from the sale or exchange of the U.S. RPI. In other words, there's no look-through rule. Now, a qualified shareholder, you can see the definition here. It's extremely complicated, especially you can see B, qualified collective investment vehicle. It's hard to navigate. If you do, and I only know a few taxpayers who have done that, it can be advantageous and worthwhile as a method to aggregate non-U.S. investors to invest in the U.S. REITs. Next, special shareholder is a qualified foreign pension fund. Once again, not treated as a non-resident alien individual or foreign corporation, and it's exempt from FIRPTA tax on the gain from sale of U.S. RPIs. and distributions from the REITs attributed to sales of U.S. RPIs. And a qualified foreign pension plan, as you might expect, is established under foreign law to provide pension and retirement benefits. No single beneficiary has the right to more than 5% of its assets of its in income. It's subject to regulation and annual reporting in its home jurisdiction, and it's accorded a tax benefit in its home jurisdiction either because contributions to it are deductible, or taxation, or its income is deferred or taxed at a lower rate. It's important to realize this is exempt from FIRPTA in its own right. It has nothing to do with investment in a REIT. So this next chart shows as a summary basically of what we've been talking about. So first two columns shows what happens on the sale of REIT shares. The next two columns shows what happens to distributions by REIT of its sale of U.S. RPIs. In other words, those last two columns is the look-through rule, only applicable to REITs. So domestically controlled REIT, it's only applicable to sales of REIT shares. There's no look-through rule. So there's tax to a foreign shareholder of a non-REIT, and there's also to a foreign shareholder receiving a distribution attributable to disposition of U.S. RPI. There's no look-through rule. The owner of a publicly traded U.S. RPHC. So there's no tax to a foreigner owning less than 5% of a non-REIT, and there's no tax to a foreign owner of a publicly traded REIT owning less than 10%. And a distribution to a non-REIT shareholder has no look-through rule, so there's no FIRPTA tax. And a distribution to a REIT shareholder owning less than 10% of the publicly traded REIT has the same rules as that regarding the sale of shares in the REIT. There's no FIRPTA tax. Even if this, there's no tax to a less than 10% owner as well in a REIT, it's the owner of a publicly traded USHRPC. Now, the owner of a non-publicly traded USHRPC, a private REIT, once again, there's no 5% or 10% ownership protection here because it's not publicly traded. So the FIRPTA tax applies to both sales of shares and distribution of proceeds from the sale of U.S. RPI by the REIT. The domestically controlled exception, however, can protect a shareholder in a non-public REIT from taxation if it meets the domestically controlled rules. Less than 50% of the ownership is owned by foreign taxpayers. Finally, the qualified shareholder, as we said, is only applicable to REITs. There's no FIRPTA tax whatsoever on sale of shares or distributions. And the qualified foreign pension fund does not need a REIT to be exempt from FIRPTA. As Tim mentioned, nevertheless, a qualified foreign pension fund would still be interested in investing in a REIT because it's a blocker. It's still necessary to block for the receipt of operating income, such as rent, or that just dividends are received, and to the avoidance of filing U.S. tax return. Oh, I see now we have another polling question. I'll turn it back to Sean.
Thank you, Don. So the second polling question of the webinar is up on your screen, and it reads, FIRPTA applies to tax foreign taxpayers on rent received from real property owned in the U.S. True or false? Please make your selection now and be sure to click the Submit button to get credit for your answer. We'll give it just a few more seconds. Be sure to click Submit. Okay, let's take a look at the results. So 73.8% of the audience said true.
Okay, so FIRPTA only applies to dispositions. So actually the answer is false. It does not apply to normal distributions of operating income. Okay, so now I'm going to turn it over to Craig, who'll learn about potential structures for foreign investment in the U.S.
Great. Thank you, Don. Now that Tim and Don have covered the building blocks a foreign investment in the United States, FDAP, ECI, and FIRPTA, the following section will cover possible ways to structure foreign investment in the United States real estate using those building blocks. As a tax advisor, you will often be asked how best to structure your company or client's investment. There are generally 6 ways to structure those investments. They are investing through a REIT, a direct investment, investment through a partnership, investment through a U.S. corporation, investment through a leveraged U.S. corporation, investment through a foreign corporation, and investment through a U.S. corporation owned by a foreign corporation. We will now walk through these alternatives, starting with investing through a REIT. As we discussed briefly in Webinar 1, there are many advantages to investing through a REIT. So the following slide shows the basic structure that you would use if you decided to invest in a REIT. Now, as we said previously, a REIT blocks ECI and commercial activity for all foreigners, including 892 investors. It also blocks having the need to file U.S. tax returns on the receipt of operating income. The general operating rules is that ordinary dividends from REITs are subject to 30% withholding, as Tim mentioned, as they are generally treated as FDAP distributions. However, as Tim also mentioned in slide 11, they may be reduced by treaties. And also that they are exempt under Section 892 for foreign governments and sovereign wealth funds. With regards to capital gain distributions from the sale of assets, as Don mentioned in slide 23, there's generally a 21% withholding for corporate investors, which is the highest current tax rate, and 20% withholding for non-corporate investors, also the highest tax rate. However, in addition, there's a branch profits tax of 30% for corporate investors on capital gain distributions, including sovereign wealth funds and sovereign wealth foreign governments. However, branch profits tax may be reduced by an applicable treaty. Also, as Don mentioned, there's an exception for distributions to 10% or less shareholders in public REITs. In addition, the sale of REIT stock, there is no withholding and no branch profits tax if the REIT is domestically controlled or if the 892 investor owns less than 50% of the stock of the REIT, or if the investor is a qualified foreign pension fund. Sale of a non-domestically controlled REIT stock is subject to FIRPTA, but not branch profits tax for non-sovereign wealth funds and non-qualified investors, and for non-10% or less shareholders in public REITs. To the extent that those exceptions do not apply, there's a 15% withholding on the gross sales price unless a withholding certificate that Tim mentioned is issued to the seller. So that's the basic REIT structure that applies to investing through a REIT. There's an alternative which would allow the REIT to be leveraged by having the foreign investors make part of their investment through a REIT. However, that investment is subject to certain qualifications and limitations. The dividend or the interest paid to the foreign investors, if the portfolio interest exemption applied, would have a 0% withholding on that interest. Alternatively, the interest may be subject to a treaty reduction, or 892 would apply to reduce that withholding to 0. However, to qualify as portfolio interest, the foreign investor has to own less than 10% of the voting interest in the REIT, either directly or indirectly. The foreign investor cannot be in the business or trade of lending, and the loan must be in registered debt form. In addition, the payment by the REIT is subject to various limitations. There's a limitation under Section 267 such that the REIT is only entitled to a deduction to the extent the interest is actually paid to the foreigner. In addition, under Section 385, there are a number of rules that could apply to limit the deduction for the REIT with regards to that payment. So while leveraging the REIT has, in some cases, advantages, they're also subject to certain rules that may limit its ability to achieve those exemptions. As we discussed in Webinar 3, the use of tiered REITs have become popular for foreign investors because of the difference in taxation between the sale of the stock of a domestically controlled REIT and the sale of property. The gain on the sale of a lower tiered REIT would not be subject to FIRPTA withholding for sovereign wealth funds and for qualified foreign pension funds. There is no withholding with respect to other investors if the lower tier is treated as a domestically controlled REIT, and there is no branch profits tax for corporate investors on the sale of stock. So the use of tiered REITs has a number of benefits for foreign investors. In addition, you can use a tiered structure to achieve domestically controlled REIT status, which, as Don mentioned, is one of the most commonly used exceptions in structuring foreign investments. So in this example, we have both 892 investors, and we have U.S. investors, and we have other foreign investors. So in this case, the goal is to make the upper tier domestically controlled and therefore have the lower tier be not necessarily domestically controlled, but a entity that the sovereigns can sell without tax because they don't rely on a domestically controlled REIT exception. So by splitting the REITs between an upper tier and a lower tier, just looking at the upper tier, because the U.S. shareholders own more than 50% of the upper tier by virtue of its interest in the fund, that upper tier is treated as domestically controlled, and therefore when the fund sells that upper tier REIT, the non-U.S. investors will be able to rely on the domestically controlled REIT exception. With regards to the lower tier, as I just mentioned, the 892 investors do not need the lower tier entity to be domestically controlled because 892 allows the sale of stock of a non-controlled entity to be eligible for 892 exemption from FIRPTA. So by structuring the tier, by using this tiered structure, both the non-U.S. investors and the 892 investors achieve an exemption from FIRPTA, whereby if they only had one REIT, the combination of the 892 investors and the non-U.S. investors would make that upper tier REIT foreign controlled. So an important way to structure once you know who your investors are. So critical to know who your investors are because structuring will enable you to achieve something that you would not be able to achieve without structuring. Similarly, the use of a parallel fund can achieve domestically controlled REIT status. Similarly to the last example, you can have the upper tier, you can have two REITs. One is a non-domestically controlled REIT owned by the 892 investors. The other be a domestically controlled REIT owned by the combination of the U.S. and non-U.S. investors, and those two REITs can enter into a joint venture to own the real estate. So there again, we were able by structuring to create both a mechanism to sell both the non-domestically controlled REIT and the DC REIT, domestically controlled REIT, to do it. Somebody's asked, is it difficult to structure it? And the answer is, it is difficult, but it can be done. I have done this because the buyer generally does not have a problem with buying the two REITs because there are a number of mechanisms they can use to achieve a step up with regards to the two REITs. So it can be done, and to the extent that you need to structure it this way, it is something which otherwise their non-U.S. shareholders would wind up having a FIRPTA sale. Similarly, a baby REIT can be used both to create domestically controlled and non-domestically controlled entities. So, as Don has mentioned, whether or not the baby REIT is domestically controlled or non-domestically controlled is based on the rules that were changed by the PATH Act. The PATH Act provided that if the parent company is publicly traded and is a domestically controlled REIT and owns more than 50% of the baby REIT, then the baby REIT is domestically controlled. On the other hand, if the parent REIT is not publicly traded, you use a look-through approach. So in this example, the parent company REIT was not domestically controlled because the foreign investors own more than 50%, and because the parent company REIT owned the baby REIT, the exception did not apply, and the baby REIT was treated as a foreign-controlled REIT. So upon the sale of the stock of the baby REIT, FIRPTA would apply, except for people who were entitled to special exemptions like qualified foreign pension funds and 892 investors. Sorry, the next slide should say domestically controlled REIT. So in this example, the U.S. investors own more than 50%. Therefore, the parent company was domestically controlled. And because the parent company is domestically controlled, the baby REIT is treated as domestically controlled, whether the parent company was public and the special public REIT will apply, or just on a look-through basis, the baby REIT would be treated as domestically controlled. And therefore, the sale of the stock of the lower tier REIT would not be subject to FIRPTA or branch profits tax. And as we said, determining whether or not the baby REIT is domestically controlled is a function of looking at whether or not the parent REIT is publicly traded, looking at the look-through rules if it is not, and making sure you've got the correct documentation to ensure that you know who the investors are. This turning to Section 892, which, generally is a major category of investors in U.S. real estate, or either foreign governments or sovereign wealth funds. And under 892, there's a U.S. exemption for certain types of investment income, and that investment income is interest and dividends, though not capital gains. So what you have is FIRPTA can apply with regards to distributions or sales of real estate directly by a foreign investor, but will not apply to the sale of stock of a non-controlled U.S. real property interest, whether it's domestically controlled or not. As it says, rental income and the gain from the disposition of U.S. real property interests of the stock and securities are not exempt. So, as we discussed earlier, you will need a blocker to protect yourself against rental income. And this is just a basic structure for 892 investors, where the 892 investor will generally insist on coming through a blocker. The blocker generally will be a REIT. The REIT, because the REIT does not pay tax, because ordinary dividends are not subject to withholding, even though if a capital gain distribution is subject to withholding, and the sale of stock is not subject to withholding or branch profits tax, an 892 investor will often want the investment to be structured through a REIT, and typically 892 investors may often require that the REIT have a provision that it will only sell stock. The fund will only sell stock and not have the REIT sell the property interests. As we said earlier, withholding is required on capital gain distributions at 21% for corporate shareholders. The next slide, I'm not going to walk you through it because you can see it, but it basically lays out the tax consequences of investing in REITs for non-U.S. corporate shareholders. And generally, it is very favorable compared to the results you will get by investing other than through a REIT. Which brings us to our next polling question. Sean, I'll turn it over to you.
Thank you, Craig. So the third polling question of the webinar is up on your screen, and it reads, what are the advantages of investing in a REIT? Generally, no corporate tax. Sale of domestically controlled REIT stock is not subject to tax by a foreigner. Sale of foreign-controlled REIT stock by a SWF or QFPF are not subject to tax. Ownership of REIT stock by a foreigner is not subject to U.S. estate tax, or all of the above. Please make your selection now and be sure to click the Submit button to get credit for your answer. Okay, we're going to give it just a couple more seconds. Be sure to click Submit. Okay, let's take a look at the results. Wow, so 87.2% of the audience said all of the above.
And that is correct. I mean, those are some of the advantages of investing in a REIT, and you can see they're plentiful and something that your client, your company would be very invested in investing in. So we're briefly going to go through some of the alternatives. One is a very simple one. We're going to do a direct investment in U.S. real estate. But as the slide lays out, there are a number of disadvantages. Most real estate other than net lease property is generally treated as ECI. It requires the non-U.S. investor to file U.S. tax returns. Corporate investors have to pay tax on that income because it's ECI. There's a branch profits tax of 30%, which makes the effective tax rate 44.7% for a corporation, so obviously very unattractive. Individual investors pay 37% tax on the ordinary income, and if they die while owning the real estate, they're subject to U.S. estate tax. So lots of, it's simple, but, lots of disadvantages. The next alternative is to invest in a partnership. However, as Tim mentioned, basically partnerships, because they're flow-through entities, wind up having the same tax consequences of a direct investment. And therefore, if you found a direct investment unattractive, you would find investing through a partnership similarly unattractive. You could also consider investing in a U.S. corporation, but there again, you've got corporate tax at 21%, dividends are subject to withholding, though treaty reductions may apply. A capital gain distribution is also subject to withholding, other than if there's an applicable exception. Gain on the sale is subject to FIRPTA unless there's an applicable exception. And ownership of the stock is subject to U.S. estate tax. There again, so lots of disadvantages of owning through a U.S. corporate stock. You can leverage up the U.S. corporation, but as we said earlier, there are a number of limitations with doing that. So when you go through all the limitations, it helps somewhat, but I think in general doesn't overall help the disadvantages of electing through a C Corp structure. You can also invest in a foreign corporation, but there again, you've got corporate tax, you've got branch profits tax, so the 44% generally will discourage investing through a foreign corporation. And this just and the last one is you can invest in a foreign corporation, investing through a U.S. corporation which owns a foreign corporate, which is owned by a foreign corporation. There again, you've created a lot of complexity, and when you go through all the rules, probably doesn't help that much unless you wind up selling the stock of the offshore blocker entity, because that sale would be not subject to FIRPTA. And this just is a simplified version of what those tax effects are. So this last slide, let me go back to this last slide. The last slide sort of encapsulates all the pros and cons of the alternatives, and as you walk through it, you may be led to the conclusion, as I have, that the advantages of investing through a REIT far outweigh the advantages of all the other structures for the reasons enumerated here. So I offer you to look at that at your leisure. Which brings us to our last polling question, Sean.
Thank you, Craig. So the final polling question of the webinar is up on your screen, and it reads, which of the following is true? The sale of a direct interest in real estate is not subject to FIRPTA. The sale of stock by a greater than 5% foreign owner of the publicly traded, domestically controlled corporation is not subject to FIRPTA. The sale of stock by a foreigner of stock in a foreign corporation is not subject to FIRPTA. Please make your selection now and be sure to click the submit button to get credit for your answer. Okay, we're going to give it just a couple more seconds. Be sure to click submit. Okay, let's take a look at the results. So 53.1% of the audience said the sale of stock by a foreigner of stock in a foreign corporation is not subject to FIRPTA.
And that is the correct answer. The sale of stock of a foreign corporation is not subject to FIRPTA. On the other hand, the sale of a direct interest in real estate is, and the sale of stock by a more than 5% owner of a domestically controlled corporation that is not a REIT is also subject to FIRPTA. So that concludes the presentation. Please join us for webinar 6, which will be a session on cost segregation on January 11th, 2022 at 12 o'clock. I turn it over back to Sean.
Thank you, Craig. We hope everyone enjoyed today's webinar. Thank you once again to all of our speakers. If you've completed the CPE requirements, your certificate is now available for download. You'll see the instructions on the screen now. If you are a Mazars employee, no need to download the certificate. We also encourage you to tell us what you thought about today's webinar by completing our feedback form, the link to which you will see on the screen shortly. Please take a minute and click that link once we conclude here. We hope you will join us for our next webinar in this series on July 11th. Please be on the lookout for your invitation. Feel free to reach out to any of today's presenters or myself with any further questions. Thank you once again and enjoy the rest of your day. Have a healthy and happy holiday season.